Hey traders! In this video I am going to be sharing a swing trading strategy that you can implement today to earn consistent profits. But before we learn the strategy, be sure to subscribe to our channel because we share new and effective strategies every week to help you achieve consistent profits. With that being said, let's get started. First, let us understand what is swing trading. Just like day trading, swing trading is also a style of trading. The difference between a day trader and a swing trader is that a day trader will enter and exit the trade before the close of the market. On the other hand, a swing trader will hold a position overnight. On an average, a swing trade can last from 2 days to 2 months. New traders often get attracted to day trading at first. But soon they realize how difficult it is to make profits in day trading. This is because there is a lot of market noise on the lower time frames. As we go on higher time frames, the market noise decreases, and it becomes easy to interpret the momentum and trend of the market. For swing trading, we will use the daily time frame. Now, coming to the strategy, our goal with this strategy is to capture market swings that occur regularly in a particular asset. In other words, we want to capture a trend by entering the market on the pullbacks. To do so, we will use 3 indicators. Firstly, we will use 2 moving averages. Now a moving average is a line that shows the average price of the asset over a particular period of time. For instance, a 10-period moving average will show the average price over the last 10 candles. Moving averages are used to identify the trend and momentum of the market. Different moving averages show different trends. For example, a 200-period moving average will show the long-term trend of the market. A 50-period moving average will show the medium-term trend of the market. And a 20-period moving average will show the short-term trend of the market. When it comes to our strategy, we will use the 9-period and the 21-period exponential moving average. This is because we are only concerned with the short-term trend of the market. This is how the moving averages look on the chart. Here, the blue line is the 9-period moving average and the yellow line is the 21-period moving average. Now, in a strong uptrend, we will see the 9-period EMA will be above the 21-period EMA. Secondly, both the moving averages will be sloped upwards at a 45-degree angle. Another thing to take note of here is that in a trending environment, moving averages act as dynamic support and resistance. This means that price will bounce up from the moving average in an uptrend. When we see these signs of an uptrend, we will only be looking to go long. In other words, we will be looking to buy. In a short-term downtrend, the 9-period EMA will be below the 21-period EMA. And both the moving averages will be sloped downwards at a 45-degree angle. The moving averages will also provide strong resistance. This means that there will be strong rejection when the price touches the moving averages. These signs will indicate a strong downtrend. And in a downtrend like this, we will be looking for sell trades or shorting opportunities. This is how the moving average looks in a sideways market. As we can see, there is no clear direction of the trend. Hence, we see that both the moving averages do not show continuity in any direction. In fact, both the moving averages are virtually flat. The moving averages also give crossovers multiple times. In such a market condition, we want to avoid trading. Our strategy will not work in such market conditions. We need a trending market to trade this strategy. The third and last indicator that we will use is the Relative Strength Index. The Relative Strength Index is also known as the RSI. The RSI indicator shows the relative change in the price during a set period of time. For instance, the default 14-period RSI shows the relative change in the price over the last 14 candles. The value of the RSI revolves from 0 to 100. Hence it is an oscillator. This means that like a pendulum, the value of the RSI revolves from 0 to 100 and vice versa. According to the basic rules, when the value of RSI is above 70, it is said to be in an overbought condition. This indicates that the market is above its true value, and a downward move should follow. Similarly, when the value of RSI is below 30, it indicates an oversold condition. This means that the stock is below its true value. Hence, an uptrend should follow. When it comes to our strategy, we will use the 2-period RSI. Instead of using the 70 level for the overbought condition, we will use the 90 level for the overbought condition. Similarly, we will use the 10 level for the oversold conditions instead of the normal 30 level. Let us now look at the strategy itself. The basic premise of our strategy is finding confluence between the moving averages and the RSI. Let us understand this in detail. Let us first look at the buy setup. For a long entry, we want to see the price in an uptrend. Let us identify the trend using the EMA. Firstly, we can see that the 9-period EMA is above the 21-period EMA. And both the moving averages are sloped upwards. This indicates that the trend is upwards. Both of these points indicate that there is a strong uptrend. Now, look at these points. Here we can see that the price pulls back to the moving averages, and at the same time, the 2-period RSI goes below 10. This is our trigger candle. There is a confluence between the moving averages and the RSI. After the appearance of this trigger candle, we will place a buy stop above the high of this candle. We can keep our stop loss below the trigger candle. Now, when it comes to profit taking, there are a few ways to exit. We can exit at the nearest resistance, or we can exit at 1:1.5 risk-reward ratio. But, the best way is to exit when the RSI hits 90 level. As you can see, after hitting the 90 level on the RSI, the price witnessed a pullback, but eventually, the price resumed the trend. Now, let's look at a sell trade. Here we have the AMC stock on a daily time frame. If we look at the moving averages, we can see that the 9-period EMA is below the 21-period EMA, and both these moving averages are sloped downwards. Now, according to our strategy, the area between these two EMAs is a dynamic resistance. This means that this area should provide resistance to the price. So now our job is to find confluence between the moving averages and the RSI. Here is the confluence. As we can see that the price makes a pullback upwards. As it reaches 21-period EMA, it finds resistance and creates a red candle. At the same time, the RSI value of the candle is above 90. This indicates that the pullback might be over, and the sellers are ready to push the price down again. So we will put a sell order below the low of this candle, and we will place our stop loss above the high of this candle. Now, if we keep a very tight stop loss, our chances of hitting the stop loss will be very high. Instead, here we see that there is a previous resistance level right above our trigger candle. So, it would be better to keep our stop loss above this resistance. That way, we can allow the market some breathing space. For targets, the best way will be to exit when the RSI reaches 10 level. This brings us to the end of this video. If you like this strategy, then be sure to subscribe to our channel as we keep sharing new and effective strategies every week to help you achieve consistent profits.